Hey everybody, welcome to another market update. It is June the 1st, got the bubbly ready to go, keeping fresh while we deliver you the best market update that the city has to offer. And I want to kick off by bringing you back to December 1st of 2022. I shared this little clip just so I can show you why it's such an asset to have a great real estate team and company that studies market data so they can guide their clients in the right direction. So check out this clip. Let me know what you think.
That when things start turning around, which I believe they are already, it indicates that it's now the best buying opportunity possible. Why do I believe that? Well, inventory is just at our 5-year averages, even though unit sales are down 40% to 40%, 40%, 25%, 25%, 40%. So half the homes are selling, but for some reason we still have an average of our 5-year average inventory. Our inventory is at the same level as it is on our 5-year averages. This should be about 20, 30, 40% higher than it currently is, which just means when tightening stops and potentially stimulus starts happening again, we're going to see that this inventory is going to get snatched up in a hurry. And if the inventory gets snatched up in a hurry, well, we all know what happens when more money is chasing fewer goods, prices will go up. So that is my kind of like, to be a seller right now, well, let's maybe talk about buying some investment property. So when the market does recover, your equity is swinging up with you. If you're looking at holding for that 34 months to recover your money, maybe it's the right time to buy an investment property. If you're a buyer looking to enter into the market, now may be a good time to get a good deal because competition is not very high right now. And when people start becoming greedy, that's when prices will go up, and that's when you should become fearful and then potentially looking at offloading your asset, kind of like what would have been a good idea in November of 2021.
So the reason I show you a clip like that is for a couple reasons. The first one is to show you that when you have an experienced real estate team that looks at market data, analyzes market data to deliver the best information possible, it gives our clients the opportunity to use that information to make the best decision possible for their financial success. So if anyone would have taken that advice back then and would have bought assets at that recommended time, right now, just to bring up the other screen right now, as you can see, this is the average sale price. We just finished the month of May at 7% up from the previous month. And that month of April was 9% up from the month before that. So the current average sale price in the Guelph real estate market is sitting at $882,000. And that advice was delivered at the end of December when prices were at the average in November was $736,000. That is almost $150,000 that we would have made clients that took our advice at that time. Many clients did take our advice and now they're sitting pretty, and some decided to sit on the fence, which is okay, that's their choice, and some probably didn't listen to it at all. But that's why we are here to give you the best real estate information possible so you can make the best decision. So if you're interested in learning more about what's going on in the real estate market, stay tuned. All right, to kick off this market report, we're going to start with the usual. We're going to look at the macroeconomic environment, jump into the interest rates and how the interest rates are holding up and how that could affect the marketplace. See what's on the inventory. We're going to look at the inflow of how much inventory is coming to the market, outflow, how much inventory is leaving the market in terms of sales, how many homes have failed to sell. Then also look at the average sale price, average days on market, et cetera, et cetera. So now you're going to have a holistic picture of what's going on in the real estate market. Okay, so let's start with the CPI, macroeconomic information. As you might have heard, that CPI total inflation came in at 4.4% in the month of April. And then in the month of March, it was at 4.3%. So we had a 0.1% increase in inflation. And that has caused a lot of drama in the news outlets and a lot of speculation that the Canadian federal government is going to raise their key lending rate, their key policy rate, which will then trigger higher interest rates for Canadians on their mortgages and then obviously on their credit lines. And I just want to stick here for a little minute and explain my thought process and what's going to happen. Definitely since August, we have seen a nice steady downtrend trajectory. And the bank was able to look at that and say, hey, clearly we're in a downtrend. The fight on inflation is going in the right direction. And that's why the last time they met, they decided to pause interest rates. And with the 0.1% increase uptick, I don't believe that it's going to give enough ammunition for the bank to actually raise rates in their upcoming policy meeting. And that upcoming policy meeting, just to let you know when that is, will be on June 7th. So in 6 days, they're going to meet and they're going to decide whether or not they're going to hold interest rates or raise them. And the interesting thing is that on June 27th, we get the May numbers. It's not June 17th, it is June 27th. We're going to get the May numbers and see what happened in May. And I'm just going to actually pull something up for you right now. I'm just going to pause the video. All right, I got what I wanted up for you so I can show you. So why did that inflation go up that 0.1% anyways? Well, there was three main contributors to that inflation going up. One was gas prices. Gas prices rose 6.3% in the month of April. And I can actually pull up the chart right here. As you can see, in March, we were actually pretty low, and we had decently low fuel prices in March, crude oil prices. And then the price per barrel shot up to $82 per barrel in the month of April. And now, when I think the Bank of Canada is going to sit down and see, okay, well, what caused inflation? Well, oil was one of them. And then back to where we are now, we can see that oil's back down to $70 a barrel. So that pressure that the gas prices have put on the economy have now eased up again for the month of April. So that should bring the inflation down for the May report that's going to be coming at June 27th. On top of that, The other key indicators that drove inflation was the cost of housing, shelter. Mortgage costs are up 28% on an annualized basis, and rents are also up at 6.1. So increasing the interest rates are actually going to have an adverse effect because that's going to continue driving these costs up, which are the key contributors to inflation in the first place. So coming back to this graph right here, we had a healthy downtrend. And then in the month of April, we had inflated gasoline prices, as well as the two major contributors are mortgage interest rates and rental rates. So if we look at that data, and the Bank of Canada is going to make a decision. The reason I believe they're going to hold is because in July 12th, on June 7th, they're going to meet. June 27th, we're going to get the May numbers, and then they're going to be meeting again in July. So it's not like they're not meeting for 2 or 3 months. They're meeting absolutely right away the next month. So what I think they're going to do is they're going to pause. They're not going to do anything. They're going to take a look at the financial reports that are going to be coming out on June 27th for inflation in May and see if those gas prices deflated inflation up to bring inflation back down. But you can guarantee this, though. If we get 2 inflation reports in a row that go up and up, now we've established a trend to the upside, and then you can definitely guarantee that July 12th, we're going to see an interest rate increase. So as a consumer, what we're looking for is that the Fed should pause rates, and then and then we're hoping that on June 27th, the May inflation reports actually can come back down, and we're not going to see a double increase. So we're not going to establish an upward trend. That's essentially what we're looking for on that. Okay, I'm going to kind of move off of this, and now we're just going to get into what's happening in the real estate market. So when we're looking at interest rates and what's happening there, with some of this stuff that's happening once that inflation went up that 0.1%, it's caused a little fear in the market, and that's driven up the 5-year bond yield to 3.4% where we're sitting right now. And we can already see that the banks have already increased interest rates off their lows that we hit back in May at 4.29%. So they're already at 4.49%. And the reason I believe that this might go up again is because our spread between the bond yield and the current interest rate is only at 1.09%. Anytime you get close to 1% is a great trigger. It's usually a great trigger for interest rates to go up. It's a great predictor for interest rates to go up. So if bond yields are going to stick around to 3.4%, well, we can just look back at history, which I have right here. The last time it was at 3.4%. Mortgage rates were actually closer to 4.8%. So we had 2 really strong months in the real estate market. And if this continues, I feel if there's a little bit uncertainty with what's coming up in the next little future, I believe June is likely going to be a bit slower than the month of April and May. However, that could be offset by the lower amount of inventory and the buying pace that's picking up. It's just something that you want to look out for. And then obviously when you're in a real life scenario, if you're actually looking at selling your asset or purchasing an asset, sitting down with an expert and walking you through this data and making sure we're applying the right information for your scenario is always going to be key. Okay, so moving on. Let's take a look at what's on the marketplace here. So currently we're sitting at 283 units on the market. Currently our 5-year average is 283, and we only have 196 units on the market right now. 28 of those units are conditionally sold, so we only have 168 active pieces of inventory that can be scooped up right now. As far as the asset classes, we seem to be under our 5-year average on every single one. Singles are under, semis are under, towns are under, and so are condos. So we don't have the inventory we want. And that's clearly articulated over here in this graph, where last year we had quite a substantial amount of units, 307 units for sale, and we currently only have 196 units. So we're substantially down. It's actually close to 56% less inventory than we usually have. And we have 44% less inventory than our 5-year average. So again, we're back in this inventory crunch, right? The government kept promising us they're going to remove the red tape. They're going to build more houses. We're going to get more inventory to the market. Well, as you saw from that clip in the previous video, I was saying how astonishing it was that we don't have more inventory in the market with the lack of sales. And there's just not, again, enough inventory. There's a little bit of good news coming out. Inflation's going down. Everyone's getting excited. Boom. And real estate's getting scooped up. Interest rates are shooting back up again, right? So again, it's a failure to deliver inventory. That's going to be, again, the reason we're going to get into multiple offer bids, the reason we don't have enough housing for people, and just too many dollars chasing too few goods. And if too many dollars chase too few goods, prices will always go up. That's what we're facing right now again. So yeah, here we go. So I mean, if we get more positive news and inflation goes down in the next report, Fed, so if the Bank of Canada holds their rate, the next inflation report goes down, you can 100% guarantee that's going to spark buying interest again, and then we're going to see another really rampant month of purchasing. Okay, so moving on, let's get into the flow numbers here. So in the month of May, we had 9.1 per day, 9.1 homes per day hit the market, which is 21% down. So we still have not enough homes flowing into the market based on our 5-year averages. Outflow, on the other hand, is picking up pace. we have an average of 7.2 homes sell per day. And what happened in the month of May? We were at 6.6. So it's still down. It's 7.4% less homes sold based on our 5-year average, but that is a dramatic improvement from where we were at the beginning of the year and even just last month. At the beginning of the year, we had sales, 30% less sales, and last month we had 18% less sales, and this month we only have 7% less sales. So you can see, obviously, the purchasing trajectory is moving upwards, up and to the right. Okay, next, let's look at outflow, and here's another good indicator that the market is really strong and stable. We had only 2.3 homes fail to sell per day, and our 5-year average is 3.1 homes failed to sell per day. So again, less homes are failing to sell, sellers are coming to the market, buyers are consuming them, and how fast are they consuming them? Well, pretty quick. 17 days it took to sell a home in the month of May. And then let's take a look at the average list price to sell price ratio. As you can see here, it's 100%. So it's slightly softer than the month of April. And as you can see that it is a little softer because it went up 6.9% versus the 9%. So one extra day on market, a little softer on the list price to sale price ratio, but still a really great strong return on the month over month average sale price. So let's look at the quarterly report and kind of show you what's going on there. I'm going to bring those up for you right now. So on the quarterly basis, we could see that in Q1, we went up 1.48% from the previous quarter, Q4 2022. And then in the second quarter, we're up 13% from the previous quarter. So this market has been extremely strong. Q2 has been really good to anyone that bought in Q1. And there's definitely still room to grow. Like I said, if the market data comes out that inflation is going down still, Fed pauses the rates, they're not going to raise the rates. This is going to spur more buying activity, and I really do believe, based on the trajectory we're going on, we're going to catch up to that April peak that we had, April 2022 peak. It's going to be a lot quicker recovery than we did in 2017. And I'll again just show you what I mean here, in case you're the first time watching something like this. As you can see, in 2017 we hit our peak here, and it took 34 months to hit that peak again. Here we hit our peak in April of $1 million, and we're already accelerating quicker than we did in the recovery of 2018, 2019, and we're already at 882,000. If more good news comes up, if there's continually a lack of inventory and there's no new supply coming in the market, you can definitely see that squeezing to a higher level quite rapidly. Okay, and I'm just going to pull up another report for you after this. I just want to find the quarterly reports here. Quarterly list price to sale price ratio. As you can see for Q2, we're selling homes at an average rate of 100% list price to sale price ratio, which is up 4% from Q1. And then on the other quarterly report, which is the quarterly average days on market, in Q4 we were at 29 days. At Q1 we were 21 days, and at Q2 we're at 17 days. Again, all the lead indicators are showing that the market is improving, and now we probably are going to have a little bit of softness, but it's not going to be crazy softness until we hear what's going to happen with the reports. Okay, moving on. I'm going to wrap a bow on all of this and what the market's looking like here. This is the story of the year. So we've had 1,126 units flow into the market. That is down 24% on our 5-year average. We've only had 809 homes sell this year, and that pace is now picking up though, however. So we've had 21% less sales than our typical 5-year average. Here's a nice positive indicator. Only 289 homes have failed to sell, and that's an improvement for last year. So we're failing to sell less homes versus last year, and it's over a 5-year average. Based on our 5-year average, we've sold 2 homes less are failing to sell. Sorry, that took a while to get out. And then based on last year homes were failing to sell like crazy, and 115 less homes have failed to sell this year than last year. Total net units we've added to the market has only been 28. So hardly any units are actually being added to the marketplace here. When you're looking at this graph, what are you looking at? Well, this blue line is our failed to sell line, okay? This orange line is how many homes we actually sold, and the red line is the combination of the orange and the blue line. So that makes the red, and the green line is how much inventory is flowing into the market. As you see, the inventory is not flowing in enough, and we actually had more outflow than inflow, and we're pretty much dead on here. So like we're not getting any new inventory to the market. It's all just getting sucked up right away. And as you can see here, the gray line is our 5-year average inventory level, and the light gray line, sorry, is our current inventory level. So you can see we've been pretty much suppressing inventory the whole time. Okay, so what does that mean? Well, with 196 units on the market, with 9.1 homes flowing into the market a day, and 6.6 homes selling a day. So essentially what that means is in 30 days, we're going to have about 470 homes left to sell. And then the remaining inventory after we sell the 6.6 homes a day in 30 days, essentially means there'll be 271 homes left on the market in 30 days. So how much time will it take to sell all that inventory. Well, based on 6.6 home selling a day, it's going to take 1.36 months to sell all that inventory. Around a balanced market, we're looking at 2.5 to 3 months of inventory. Right now, we're at 1.6. So definitely tilted into the favor of the seller right now in this market. Okay, so that's essentially the market report. I know this one might have been a little bit different, but I hope you enjoyed it. If you have any questions, please reach out to the Zahn team. Guarantee you a 5-star real estate experience. So check us out, and I'll talk to you at the next one. Thanks so much.